In March 2023, Silicon Valley Bank collapsed. It was the second largest bank failure in United States history. Within 48 hours, a bank that had been operating for 40 years was gone. And one of the most common questions that followed was simple: what actually happens to the money? Today we are going to answer that question clearly. What happens when a bank fails, who protects your money, how the process works, and what you should actually be paying attention to as someone with money in a bank account. Let us start with the most important fact, because it resolves most of the anxiety around this topic immediately. The vast majority of bank deposits in the United States are federally insured. The Federal Deposit Insurance Corporation, the FDIC, was created in 1933 specifically to protect depositors in the event of a bank failure. The FDIC insures deposits at member banks up to $250,000 per depositor, per bank, per ownership category. What this means in practical terms is that if you have less than $250,000 in deposits at an FDIC-insured bank and that bank fails, you will not lose a single dollar. The FDIC guarantees it. The FDIC has been tested many times. Since its creation in 1933, not one depositor has lost a single cent of insured deposits in an FDIC member bank failure. Not during the savings and loan crisis of the 80s and 90s. Not during the 2008 financial crisis. Not during the 2023 regional bank failures. The insurance has held every single time. So how does a bank actually fail? Banks take in deposits from customers and lend that money out to borrowers. Mortgages, business loans, car loans. The bank makes money on the difference between the interest it charges borrowers and the interest it pays depositors. A bank gets into trouble when too many of its loans go bad at the same time, when it has invested its reserves poorly, or when it faces a bank run, a situation where a large number of depositors try to withdraw their money simultaneously, faster than the bank can liquidate assets to cover the withdrawals. The Silicon Valley Bank failure in 2023 is a useful illustration. The bank had invested a large portion of its deposits in long-term government bonds during a period of low interest rates. When interest rates rose rapidly, the value of those bonds fell. When depositors, many of them technology companies, started withdrawing funds at scale, SVB was forced to sell those bonds at a loss. The news of those losses triggered more withdrawals, which triggered more forced sales, and the spiral accelerated. The bank was seized by the FDIC within a matter of days. When a bank is seized by the FDIC, the process moves quickly. The FDIC typically takes over on a Friday and has a resolution in place by Monday morning. In most cases, the FDIC arranges for another bank to acquire the failing bank's deposits and assets. Customers of the failed bank essentially wake up as customers of the acquiring bank, their accounts intact, their balances unchanged. In cases where no acquiring bank is found, the FDIC pays depositors directly from its insurance fund, up to the insured limit, within a few business days. What about money above the $250,000 limit? This is where the risk is real. Deposits above the insured limit become claims against the failed bank's assets. Depositors with amounts above the limit may recover some or all of their uninsured funds depending on how the bank's assets are liquidated, but this is not guaranteed. This is why large businesses, nonprofits, and individuals with significant deposits often spread their money across multiple banks or use special deposit structures to maximize their insured coverage. If you hold money in a credit union rather than a bank, the equivalent insurance is provided by the National Credit Union Administration, the NCUA, for the same amount of $250,000 per member per credit union. The principle is identical to FDIC coverage. One thing worth addressing is brokerage accounts. If you have money in an investment account at a brokerage, stocks, bonds, index funds, this is not covered by FDIC insurance. Instead, brokerage accounts are covered by the Securities Investor Protection Corporation, or SIPC, up to $500,000, including $250,000 in cash. SIPC protection covers the custody of your investments in the event of a brokerage failure. It does not protect against market losses, which are a normal part of investing. A few practical takeaways worth noting. First, always confirm that your bank is FDIC insured. You can do this at the FDIC website. The vast majority of banks and savings institutions in the United States are members, but it is worth confirming. Second, if you have deposits approaching or above $250,000, look into how the ownership categories work. Individual accounts, joint accounts, and retirement accounts each have their own separate insured limits, which means a couple could have significantly more than $250,000 insured at a single institution by using different account structures. Third, monitoring news about your bank is reasonable, but keep it in perspective. The FDIC exists precisely so that the question of bank failure is not one that most depositors need to worry about. To summarize, when a bank fails, the FDIC steps in, takes over, and protects insured deposits up to $250,000 per depositor per bank per ownership category. In most cases, another bank acquires the failing bank's deposits, and the transition is nearly seamless. Since the FDIC was created in 1933, no insured depositor has ever lost money. The system is not perfect. Amounts above the insured limit carry real risk, but for the vast majority of everyday depositors, the protection is comprehensive. Subscribe if you want to keep understanding how the financial system works in plain English. We publish a new personal finance video every week, and if you want to understand where the safest place to keep your emergency fund is, our video on high-yield savings accounts covers exactly that. Link in the description. See you in the next one.